All right, today we're going to pull back the curtain on a really clever piece of financial engineering, the Tobique gaming license. Now, on the surface, it just looks like a simple license for online gaming. But behind the scenes, it's this incredibly sophisticated setup, all designed to legally slash a company's tax bill. So let's dive in and see how it really works.
I mean, just imagine this for a second. What if you could launch a global online casino, operate pretty much everywhere, but keep your tax burden as low as it could possibly legally go? Well, that's the powerful promise that's made the 2-week license such a hot topic in the gaming world.
So what's the big draw here? It all starts with a simple, incredibly powerful promise: a tax-free haven for your gaming revenue. And honestly, that's the headline that gets everyone's attention.
And when you compare it to some of the older, more established options, the appeal is just crystal clear. You can get a license approved in weeks, not months. The fees are low. You don't even need a local company in Tobique. Plus, a single license covers the whole shebang: casino games, sports betting, you name it. It's really built for speed and for simplicity.
But this is the number that makes operators really sit up and pay attention: 0%. The Tobique license promises zero tax on gross gaming revenue for the company holding it. You know what that means, right? More money for investment, for growth, for profit. It's an unbelievably attractive offer. But, as you've probably guessed, it's not quite that straightforward.
Yeah, see that 0% promise? It actually creates a huge practical problem. How do you actually run a global business and, get paid when you're an offshore company that doesn't really have a physical presence? This is the central puzzle that we need to solve.
Just think about it for a second. You've got players in Europe, in Asia, they want to deposit money with their credit cards or through a bank transfer. Well, they need to pay somebody. And let's call it a ghost company in a tax haven. That's just not going to fly with any major financial institution.
And here's the real kicker. Major payment processors, EU banks, they're extremely reluctant to work directly with offshore companies. I mean, with all the strict anti-money laundering regulations, they need a tangible, legitimate partner they can see and deal with. So this is where that 0% tax dream hits a very, very real wall.
And that brings us to the really elegant solution that makes this whole thing work. It's a sophisticated two-company structure, and it's specifically designed to bridge that gap between the offshore tax haven and the onshore financial world.
So here's how they set it up. You've got two different companies working together. Over on the left, you have the offshore holding company. Maybe it's in a place like Costa Rica or Belize. Its job is to hold that valuable tax-free Tobique license. Then, on the right, you have its subsidiary, a payment agent company set up in an EU country like Cyprus. And this company, it has one job and one job only: to process all the player payments.
Okay, so how does the money actually move through this system? Well, it's a pretty clear 4-step flow. First, a player makes the deposit. The Cyprus company, with all its EU bank access, processes that payment. Then, it keeps a small, pre-agreed service fee for doing its job. Finally, the rest of the money, the vast majority of it, is legally transferred upstream to that offshore holding company, where, you guessed it, it remains untaxed. Now, this might sound a little bit like a magic trick, but it's actually grounded in very well-established legal and financial rules. The absolute key is making sure that the relationship between these two companies can withstand any scrutiny from tax authorities. The legal glue that holds this all together is something called an agency agreement. Think of it as the formal contract between the parent company and its subsidiary. It clearly states that the Cyprus company is just a service provider, an agent, and it defines exactly how it gets paid for that service.
And this brings us to probably the most critical concept in this whole setup: transfer pricing. And this is where it gets really clever. You see, tax authorities have this rule called the arm's length principle. All that means is the fee the Cyprus company charges its parent has to be fair market value. Basically, what it would charge a totally unrelated company for the same work. You can't just invent a number to minimize your tax. It has to be justifiable.
So let's actually look at the numbers here. Based on expert advice, the Cyprus agent would typically retain a service fee of around, say, 4% of the total revenue. Okay, so that 4% is its taxable income. And in Cyprus, the corporate tax rate is a pretty competitive 12.5%.
And right here, this is the aha moment. This is where it all clicks. You're not paying 12.5% on all your revenue. No way. You're paying 12.5% on just that tiny little 4% slice of your revenue. So when you do the math, what happens? The effective tax rate on your total global income drops to just 0.5%. That is the real secret sauce to this entire structure. But before anyone gets too excited and rushes off to set this up, there is a massive, critical reality check. To make this whole structure legitimate in the eyes of banks and tax authorities, that Cyprus Payment Agent, well, it can't just be an empty shell company. It has to be real.
This is what's known as local substance. It means the company needs a genuine, provable presence in Cyprus. It can't just be a P.O. box or a mailing address. This is a non-negotiable requirement if you want to get access to payment systems and be able to defend your tax structure.
And substance isn't some vague idea. It means a real office with a lease. It means local employees who are actually doing the payment processing work. You need a local director. You need to keep all your business records right there on site in Cyprus. It has to look and act like a real business because, well, it is a real business with a very critical job to do.
So I think the main takeaway here is that this is absolutely not a do-it-yourself project. As one source we looked at puts it, structuring this to satisfy transfer pricing rules and international tax law is a complex matter that necessitates consulting specialized experts. In other words, you need lawyers and accountants who know exactly what they're doing.
And all of this leaves us with one final fascinating question. Structures like these, they exist in a kind of legal gray area. Today, they're considered sophisticated tax planning, but as global regulations get tighter and tighter, you have to wonder, how long will they actually remain viable? Is this the peak of financial efficiency, or is it just a temporary window of opportunity that's about to slam shut? Well, that's a question for the industry and the regulators to answer. Thanks for joining this explainer.